Welcome to the Pro Ticker Deep Dive. We are jumping straight into the global oil market today, which is, it's going through one of the most violent periods of volatility we've seen in years. The price action has just been absolutely brutal for producers. We saw WTI crude, that's the main U.S. benchmark, collapse from a peak of $77 a barrel back in early 2025, and now it's down to barely $60 a barrel by November.
That kind of selling pressure is genuinely shocking when you look at it in context. Just think about that for a second. In 10 short months, we've effectively erased nearly 2 decades of price gains. So for any investor, any global policymaker tracking energy right now, this really sets up the single most critical question. Is this sustained price pressure the start of a deep structural bear market where demand just fundamentally disappears? Or is this merely what some of us call the dangerous equilibrium? A temporary glut that sets the stage for a dramatic, even violent price reversal.
That is the perfect way to frame it, because the market is really operating under two totally conflicting stories right now. You've got the doom and gloom crowd pointing to this undeniable oversupply. And then the bulls are looking at these ticking geopolitical time bombs and saying prices are about to surge back toward $90. It's a very unusual split.
And that's what makes the environment so ripe for extreme volatility.
Okay, so let's unpack that first narrative, the bear case. What's the hard data, the concrete evidence telling us today that this glut is absolutely real?
Well, the evidence supporting the glut is frankly overwhelming. It's mathematically verifiable. Global production, and this is thanks mostly to non-OPEC suppliers, is expanding much faster than demand. Leading energy agencies are projecting a pretty significant supply surplus for the final quarter of 2025. We're talking roughly 2.7 million barrels per day, too much oil.
That is a massive number, and what makes it, scarier is the forecast that this surplus is expected to get even wider, right?
Exactly. It could potentially reach 4 million barrels per day in 2026.
4 million barrels a day? That's a serious disconnect.
It is. But as you said, the physical proof is always the most telling. We aren't just talking about numbers on a spreadsheet. Oil inventories are visibly rising everywhere. But the most alarming sign of distress, really, is the physical evidence of desperation. Industry sources are reporting about 60 million barrels of crude stored in floating tankers across the seas.
60 million barrels floating at sea. That's staggering. Why is that specific detail so important for our listeners to understand?
Because when producers start storing oil on ships, it means they've run out of economic or even just adequate land storage. It's expensive, it's inefficient, and it's the market literally shouting, "We have nowhere to put this oil."
Right. That's a huge red flag.
A huge one. And this physical glut is what forced OPEC Plus to act. They signaled their alarm earlier this month by pausing planned production increases through Q1 2026. They know they can't support prices with just voluntary cuts alone when the macro environment is this weak.
And we know that even when they do try to add supply, they have trouble actually doing it.
That's right. Even their attempts to relax previous cuts have faced severe friction due to logistical problems, infrastructure decay, all these operational challenges. Member countries have only achieved about 70 to 75% of their announced increases, so even the cartel's power to adjust is limited.
Okay, so to sum up the bear case so far, rising inventories, a massive forward surplus, and physical proof of desperation with this floating storage. So now let's shift. What's actually driving this demand fragility in the first place?
To understand the glut, you have to track the marginal buyer. And that brings us to the macroeconomic backdrop. Global GDP expansion is tracking around 2.9%, which is, sluggish compared to historical averages. We've seen repeated downgrades all year from institutions like the IMF. Europe is slow. The U.S. is grappling with renewed trade tensions.
And those tensions threaten manufacturing and logistics, which are super oil-intensive sectors.
Exactly. But the centerpiece of the demand story for the last 20 years has been China.
Right. Historically, China was the engine, responsible for, over half of global demand growth since 2003. But that role is totally flipped. Now they're acting like a massive deflationary force on oil prices.
The deceleration in Chinese demand isn't. It's nothing short of structural. Right now, Chinese oil demand is growing by less than 100,000 barrels per day, annually. Just 5 years ago, that number was regularly over 500,000 barrels per day. It's a profound shift, and it's not cyclical, it's structural.
And what are the key pieces behind that structural change?
I'd point to 3 main factors. First, the explosive growth of new energy vehicles, NEVs. China hit 20% market penetration for them way back in 2022.
So that directly kills gasoline and diesel demand.
Directly. Second, the ongoing, really painful property sector slump. Construction uses immense amounts of fuel. And third, their huge high-speed rail network, which is substituting for long-distance air travel. These are permanent headwinds.
And what's so fascinating here and what really fuels the volatility is the massive disagreement this creates in forecasts.
Oh, absolutely.
You have some agencies predicting this huge surplus, but then OPEC comes out with a much more bullish outlook. They're still expecting growth of 1.29 million barrels per day this year.
And even more in 2026. This fundamental disagreement on where demand is heading, that's what keeps the market whipsawing back and forth.
Okay, here's where the narrative gets really interesting for me. If the supply glut is so clear, so mathematical, why are some very sophisticated experts betting on a sharp price rebound? What are the counterforces that could drive a violent reversal?
This brings us to geopolitical risk and spare capacity erosion. Geopolitics is incredibly dynamic right now. Just look at the new U.S. sanctions from late October. They targeted major Russian crude producers Rosneft and Lukoil. That action alone threatens to disrupt anywhere from 500,000 to 1 million barrels per day of Russian exports almost overnight.
And you have to layer on the actual physical damage from the conflict. Estimates show that Ukrainian attacks on Russian refining have already taken out around 500,000 barrels per day of output. That's supply destruction in real time.
Exactly. But the deeper, sort of hidden risk is the erosion of global spare capacity. Venezuela's production, for example, has collapsed to barely 1 million barrels per day. It was at 3 million just a few years ago. So if you add it all up, an unexpected escalation in the Middle East, more successful attacks in Ukraine, you could easily see 2 to 3 million barrels per day just vanish from global supply.
And to put that in perspective for everyone, that's like erasing the entire daily production of a large OPEC nation in a single night.
Precisely. And if that volume disappears, this current $60 price point becomes instantly irrelevant. Prices they'd skyrocket to $80 or $90 within weeks, just on panic and lost capacity.
And we have to remember, despite the slowdown in growth, absolute demand is still resilient. The world is consuming over 103 million barrels a day this year. Global aviation, for one, has fully recovered to pre-pandemic capacity. People are still moving.
That's right. And that's what makes the current glut so vulnerable. Which brings us to what I'd call the black box variable, China's Strategic Petroleum Reserve.
Okay, for our listeners, what is the SPR and why does it matter so much right now?
The SPR is a national security tool. It's emergency storage the government holds to cushion against a catastrophic supply shock. As of early this year, China had only filled about 56% of its available storage capacity.
So there's a lot of empty space.
A lot. And if Beijing decides that $60 oil is cheap, which historically it is, and they move aggressively to restock, they could temporarily absorb anywhere from 500,000 to 1 million barrels per day of the global glut. That single policy decision could flip the entire market narrative from surplus to shortage, possibly within a single quarter.
Okay, so let's connect all these threads. What does this price pressure in the low $60 mean for the long-term outlook? How does this glut plant the seeds for the next shortage?
This is where we get into what's called supply destruction in slow motion. These depressed prices are punishing high-cost producers everywhere. We're talking about marginal U.S. shale that needs high prices to be profitable, or capital-intensive projects like Canadian deepwater. Even Saudi Arabia's implicit break-even price, the price they need to fund their state budget, is estimated to be around $70 a barrel.
So when oil is sitting at $63 house, $64, countries like Saudi Arabia are under severe financial pressure. They have to pull back on spending.
Exactly. At these suppressed levels, investment in new fields gets postponed, maintenance spending gets deferred. Now, this doesn't hit supply tomorrow, but 2 or 3 years down the line, that deferred investment creates a major supply crunch.
Looking at the charts, it's been a steep fall. WTI crude fell 22% from that $77 high in January to near $60 now. Where are the critical financial breaking points?
Well, we're sitting right on the first one. The first critical support level is right here at $60. The more serious fundamental support floor is probably in the $55 to $57 range. That band corresponds to the average cash cost for a lot of U.S. shale.
So if $60 breaks?
If $60 breaks definitively, $50 is the next psychological level. Reaching that would force widespread capex cuts and serious supply adjustments in the West.
So connecting the dots. For a longer-term investor who believes oil isn't going away anytime soon, this $55 to $70 range should probably be seen as an attractive accumulation zone.
That is the core conclusion, yes. The current oversupply, the mathematical glut, it's real based on today's numbers. But the evidence increasingly points to this being a transient state, not a permanent shift. By forcing prices so low and choking off investment, the very conditions creating this oversupply are planting the seeds of the next and likely very violent shortage.
And that structural reality is just so key. Oil is not going to disappear from the global energy system by 2030. At current prices near $60 a barrel, the case for mean reversion becomes more and more persuasive. And for anyone unfamiliar, mean reversion is just the idea that prices, when they get pushed far below their historical average, tend to snap back toward that average. We might just be seeing the setup for that snapback right now. See you all in the next Pre-Ticker Deep Dive.